crack straight on with the presentation, and please be ready with questions. I will try to leave plenty of time. I've got my clock in front of me, and I'd love to leave time for you to ask all your burning questions. So let's kick off. We had results in December, and so I am pleased to present you with those results. I've recently had the AGM. We saw good NAV growth during the 12 months, all the way back to September 2024, 13.3%. Share price was up 10.4%. There was a slight widening in the discount. And then in terms of what really matters to many people who invest, many of our shareholders in Aberdeen Equity Income Trust, is the dividend. So we have got a very long period of dividend growth. I am going to explain why I will continue to grow the dividend. We did 22.9p of dividend per share, which when you consider the share price, I think today is about £3.20, is actually a reasonably attractive dividend yield, around about 7%. Revenue return per ordinary share covered that dividend. So I will explain in the coming slides how we intend to continue that strong dividend going forward. And the board, I should add, has already said that it's committed to extending that dividend track record, currently 24 years, to 25 years, with at least 23p of dividends per share in 2025. Many of you, I know, have needs for income, and perhaps you're at a stage in life where you want your investments to work hard for you in terms of the income that those investments generate, and that's what I'm intending to do. So we've had 24 years of continuous dividend per share growth. I've been managing the trust since 2011, so hence I've gone back to my inception back in 2011. There was a golden period, as many of you will know, for mid caps and small caps here in the UK. You know, if you remember the Rose Garden, I always think back to the Rose Garden. Those of you with long memories of Nick Clegg and David Cameron looking at each other lovingly in the Rose Garden at 10 Downing Street. And I think that I look back on those years, and of course, back then, there was quite good economic growth in the UK. Lots of things have happened since then. Most notably, as you can see from this bar chart, COVID. COVID was a pretty wretched period for all income investors. We were no exception, and we did not cover our dividend for 2 years back in 2020 and 2021. We are back on form now. We are covering the dividend. We're finding plenty of investments to help us to achieve that. And as I said, the board is committed to a 25th year of dividend per share growth. We've got lots and lots of dividend reserves. If you actually think about the gap between the dark blue bars, which is how much revenue or earnings or portfolio income we generate, and you think about the light blue bars, what we pay out, that gap has been pretty much continuously, apart from those 2 years, in favour of rebuilding our revenue reserves. That means we've now got about 9 or 10 months of revenue reserves that we could pay out if we needed to on a rainy day. And that's exactly what we did in 2020 and 2021. So that's the benefit of the closed-end investment trust approach. So look, what do we look for? We look for a yield, we look for dividend growth, and we look for the potential for capital growth. And we don't know at the beginning of any given year what will drive the total return. It might be, in a year like this year so far, it's actually quite weighted to dividend yield. So if you think about some of our yield stocks, they've done really well this year because the markets are quite uncertain, lots of worries about tariffs. But then you also get companies with good long-term dividend growth. And what's really exciting to me, as I present this sort of nirvana idea of sort of where we get all three, is where we see positive change and the companies that we invest in see their valuations re-rate. And I'm going to explain in 3 cases how that is happening here and now in the portfolio. We get this re-rating. In other words, you buy a stock on whatever, 8 times earnings, let's say, 8 times PE. And it gradually, as the good news comes through, that PE ratio goes up from 8 times to 9 times to 10 times. And then eventually you can actually find companies that you bought on a single digit PE end up trading on 15 times earnings. And so income and capital can go hand in hand. And I think this is really what I want to explain is the fundamentals that we look at, the analysis that we do really underpin this process, because we're looking for companies with good, strong growing earnings, good, strong growing cash flows and dividends. And so that fundamentals can drive dividend growth. At the same time, we want to know what the market will pay for that. So in fact, that's the judgment aspect of the job. So that's the 8 times to 12 times type PE ratio. And in terms of dividend yield, that could be a dividend yield where you start with a yield of 8%, or people take a sharp intake of breath at that point and say, oh, how can you invest in companies with such a high yield? Well, because they don't deserve to be trading on such a high yield. There are lots of stocks in my portfolio which are yielding 8, 9, 10%, which I think should be yielding 4, 5, 6%. And that process plays out. We then have a rising share price, and that can produce this capital growth. So that's the theory. And across the portfolio, we are seeing really attractive dividends, and we're seeing valuations low. So we're seeing PEs on 9 times, dividends median 6.3%. There are lots higher, and there are also lots lower, because we've got a big broad range of yields, all the way from 0 to about, I think, mid-teens at the highest level. But it's backed up by cash flow. So the free cash flow yield, that's how much cash the company's left with at the end of the year that they don't need to spend on all the fixed costs that they have to pay come hell or high water. So look, free cash flow that's free to them, they can choose what to do with it. They are spending 2/3 of that broadly on dividends, which I think is pretty healthy, because they can spend the other 1/3 on lots of other things like buybacks and investing in future growth initiatives. Then we've got dividend growth. Okay, it's not quite as high as the market at the moment, but that sort of meanders around about the market level of sort of 3, 4, 5% typically. We've got dividend cover 1.9 times, which is pretty good. Means that the companies that we invest in are covering their earnings, their dividends with earnings, around about 2 times, so about a 50% payout ratio. That's pretty good. And they're not as highly geared as the wider market. So we've got pretty conservative balance sheets, 0.9 times net debt to EBITDA. And finally, they're making good returns, and we're not paying very much. And if you think about to me, the PBV, price to book value, best way to visualize that really is to say, well, look, if you were starting from scratch with one of these companies, do you really think you could do it for net asset value? Because that's often understating the true value of the business. If you're starting this business from scratch, you'd be paying way more than 1 times for that business. So it means that there's very little incentive for new upstarts to come into that market. So look, valuation is key to this strategy. We do focus a lot on valuation, and I've talked a bit about dividends, but let's also think about what else is driving our returns in this year that's just gone by. Well, we've had 25 of our 50 stocks are doing buybacks, about half of the portfolio. We've had 5 of our stocks, about 1/10 of the portfolio, doing special dividends. And if you add up dividend, buyback, special dividends, there are many examples in this portfolio that are generating a distribution yield, as it's called, that if you add all those things up, over 10%. And sometimes we've had companies just recently paying as high as 20% distribution yield. So if you think about what that means, if you invert the distribution yield, we're getting into the maths now of it, and you say, well, look, that's how much you get each year. So if you get 20% per year and the share price stays flat, and you forget about discounting, well, actually, you need 5 years in order to break even. Now, obviously, you've got to think about, you've got inflation and so on. But look, keep it simple. 20%, 5 years is 100%. You get your money back after 5 years. So look, I see that as incredibly good valuation support. That margin for safety that Benjamin Graham talks about in his writings. So look, focus on valuation has led us to companies with great cash flows, and the maths is playing out. And we had 4 bids as well. So look, buybacks, special dividends, M&A. We had Hargreaves. We were buying that around about the lows. Yes, original investment, we paid more than the ultimate bid, but we bought lots and lots of Hargreaves down at the lows at about £6.57. So in the end, it turned out to be quite a neat investment. Time and the Windows and Doors company got taken out by a US support services business called Quanex. DS Smith, the paper company, got bought out by International Paper, and Sentiment got bought out by Anglo Gold. Can you see the pattern here? The pattern is that international bidders can see this enormous valuation gap. And, you may have seen a famous investor, Terry Smith, talking about how, well, actually, there isn't much difference between the US and the UK. I'm telling you there is, and overseas bidders are telling you there is. There may not be at the mega cap end of the market, but there certainly is at the small and mid cap end of the market. That's why we're seeing this surge in M&A. So our focus on valuation is leading to companies with these wonderful dividends, wonderful buybacks, wonderful special dividends, and surging M&A. And I think that's a really good backdrop. So Nirvana, what do we invite from Nirvana? Well, I'm going to talk to you about a company that perhaps 2 years ago people would have felt too afraid to talk about because they would have said ESG is not very good on a tobacco stock. Well, I'm telling you, we invest with ESG in mind, but we invest primarily with the focus on financial returns. How can we help you to deliver that income that you so much need in a time of a cost of living crisis? And that's what we're doing with Imperial Brands. We've seen a distribution yield that's currently 12. Yes, this was one of them that was over 20 in when the shares were £14 back in 2021. As you can see from the share price chart, the distribution yields, the buyback and the dividend was over 20%. So cash flow is really strong here. We've got the yield, we've got the dividend growth, tick, tick, tick. We've got the differentiated approach. Look, most people would say we will buy Diageo. And look at the share price of Diageo over the last 2 or 3 years compared with Imperial Brands. A straw poll would have been 9 out of 10 people saying, of course you buy the beverage stock. Of course you sell the tobacco stock. And yet the opposite has been true. So catalyst for further outperformance. Well, I will be attending their Capital Markets Day in London in 2 weeks' time. And they will come out with new plans because they've already hit their LTIPs. They've hit their targets. And so I'm moving on to the next slide now in the interest of time because I want to leave plenty of time for questions. Galliford Try, another great dividend stock, which has turned out to be a great share price return as well. Again, if you go back to 2020 when they demerged Vistry, we sold Vistry and again, look, a bit like Diageo versus Imperial Brands, who would have thought it that you buy the construction company, which was the ugly duckling for the previous 10 years, and you sell the house building company? Most people would have said you're mad to do that. But now we're seeing a surge in dividends. We've had another massive increase in dividends just today. In fact, I'm just checking the numbers because they came out with very, very strong earnings this morning. The shares are up about 6% as I speak. A big earnings beat. Brokers putting through earnings upgrades of double digits here, like 10 to 12%. Dividend per share up 38%. I've just checked to make sure I got the numbers right. They are in a sweet spot. Water investment is surging. Sorry about this. This is my... That was my fire alarm, which happens every week. I should have anticipated that. Sorry for the noise. So net cash, they're growing the dividends. And of course, this is driving the dividend. So they go hand in hand. We get the surging earnings, we get the surging dividends. It is differentiated, and there are catalysts for further outperformance because they're on track to hit their earnings targets faster than 2030. So they're going to have to come back to their targets and reshape their targets. And here's another company, TPI Cap, which is the world's largest interdealer broker. And again, a very ugly situation a few years ago. People would have said, look, there's no pricing power, volumes are low, there's no volatility, nobody's trading. So there were cyclical headwinds, and people would say, well, look, it's all going electronic. Nobody's going to be picking up the phone and dealing through TPI Cap. Well, TPI Cap have invested in electronic systems. They are the provider of choice. They are sitting on every dealer's desktop in all the big investment banks and increasingly spreading into the buy side onto the fund management side. So they are addressing all those worries. They've transformed their balance sheet. They're now paid down all the debt, they're net cash, and they are a beneficiary of the volatility that we're seeing. And Donald Trump is a godsend for a company like TPI Cap because, of course, every day we're seeing press conferences where things are happening and volatility is picking up on the back of that political and macro instability. So they are a real beneficiary of that. Now, Parameter is their data business, and this is the real jewel in the crown. This is a company that has many of the hallmarks of LSE's data business, and they are looking to list this on the New York Stock Exchange later this year. So this could be a real catalyst for TPI Cap. So here, looking across the portfolio, are our stocks. Dividend yield on the left-hand side here, and market cap running along the horizontal axis you can see there. So no real correlation. We can see dividend yield in the mega caps. We can see dividend yield in the small caps. We can go all the way up to mid-teens in some cases. Ithaca Energy is one of those, the North Sea oil and gas producer. Shares have done very well recently because, of course, they are getting their operations into shape, and so they're able to deliver very strong cash flows, and that's coming through in the form of dividends. And this is how the portfolio looks overall. So 50% large cap. We want to be nimble. We want to be able to buy large caps when they make sense, like Imperial Brands, but we also want to own these undervalued mid and small cap stocks. At the geographical level, we have got 47% UK, which is a bit higher than the FTSE All share. The FTSE All share, of course, is dominated by mega caps. Over 80% of the UK market is mega caps, which are largely international earners. So we are by default being index agnostic, meaning we go anywhere. We are going to be heavier in the UK. And then in terms of weightings, we're pretty heavy in financials. We have got quite a lot of energy, and we've also got some consumer staples, which is this tobacco weighting that we've got. So we are selective. We've got 50 stocks in the portfolio. Here are the top 10. Imps at the top, delivering some fantastic total return there. We've got BAT as well, who are lagging behind a bit operationally, but they are still very, very strong and in good shape. So BP just done its capital markets day, looking to improve their performance. So we've been buying that one in the last few months. We've got some banks in there, HSBC and Barclays, providing some fantastic share price performance recently. And then I've mentioned Galliford Try as well in there. Moving on, just recapping on how we do it. We're looking to generate ideas consistently, looking at the research ideas that we're getting through from the analysts, stock-specific ideas. We run these through the quant model. We say, look, they may sound good ideas, but how do they screen? Do they have what we need? Do they have dividends? Do they have growth? Do they have momentum? Do they have valuation on their side? And so we're looking for that. And we then run the portfolio construction. We've got tools that allow us to put the portfolio together. We do look at beta. We try to keep the beta about 1x X gearing. So we are looking at that. And we've got some golden rules here. We've got intentionality. So has each stock really earned its place in the portfolio? If we started with a blank sheet of paper, would we start with these ideas, or are there other ideas on the bench bubbling under that we can put to work? And we've sharpened our execution, and that's helped us to deliver some much better performance in the last year and a half. So looking at Peter Hill partners, this is my idea, which has grown increasingly in the portfolio. It's a big weighting now in the portfolio, and I wanted to show this to you really because it's a stock where we got it wrong initially. We underestimated the impact of rising interest rates on private equity. They are a private markets business. They have 20 investments, both sides of the Atlantic. Goldman Sachs Asset Management putting those investments together. They're really a fund of funds business. So they're collecting individual investments in these private markets businesses, and they did badly on the initial float. They fell dramatically. But what did we do? Well, we thought about this. We thought about, are they still delivering fundraising? Yes, they are. They're still delivering 20, 25 billion of fundraising each and every year. We then said to ourselves, look, do we think there's potential for this stock to recover? Are they generating enough cash? Yes, they are, to deliver these wonderful capital returns. They've done 3 special dividends just in the last year. So we sharpened our execution, we topped up meaningfully, and as a result of that, we've delivered some very strong performance. And that's what we did with Hargreaves Lansdown. So we don't bail out, we double down on the research, and we try our best to make sensible execution decisions. And so the performance of the portfolio is coming through nicely now, and you can see this is over the period to December 2024. We believe that's driven by strong company results, and then all these distributions plus the M&A. It's all helping us to deliver that strong performance. I can see the clock is ticking. I'm just going to finish off with a discount slide. So we have managed to get the discount back towards parity with NAV. There are moments when the market panics, and at those moments we are ready. We have occasionally done a buyback when the discount's blown out. So we are there. The board is aware of discount when it blows out. But look, we believe what we're doing is really differentiated. The yield is really differentiated. It's backed by earnings. So that's something that not everybody can say. And it's built on an investment process with valuation at its heart. So I am not compromising by buying higher yielding stocks. The high yields are something that entice me. And that goes against what you may have heard from many other managers about value traps and dividend traps or whatever. We see the opportunity with a name like Imperial Brands, with a starting yield up at 11, 12%, to crunch into 6%. And that's the basis on which we've been able to deliver the strong returns in the last few years.